Good afternoon. Welcome to Midcap Radar. I'm Reema Tendulkar. With me is Sonal Bhutra, and these are the top stories that we're tracking at 1:30 p.m. Indices edge higher as stocks see good gains, broad-based gains. Metals, oil and gas, industrials and autos lead. Midcaps outperform.
Nelco surges on a pact with communications provider Intelsat for in-flight connectivity, which could be a big trigger for the company.
Auto ancillary names like Asahi India, Shanti Gears, Lumax Auto hit fresh highs on the back of higher demand from OEMs and capex plans.
Key deal on cards for Mangrove Chemicals. Sources tell CNBC-TV18 Zuari Agro is in talks to offload its stake in the company to Chambal Fertilizers.
Strong Dalal Street debut for Sirma SGS Tech. The shares list at a 19% premium to the offer price.
All right, those are the top headlines that we are tracking on Midcap Radar for you. For the markets, by the way, we have come off sharply from the highs. We did start on a strong note, but for now, Nifty is at the day's low. It's up around 60-odd points, but a sharp downtick from the top that we are seeing for this one. Additionally, we are seeing that the Midcap Index is the one which is outperforming the benchmark indices. So Midcap Index for you up around 158 points with advance decline ratio in the favor of advances. But let's talk about some companies now. MapMy India is in focus. Company posted a strong set of Q1 FY23 numbers, and there have been some updates in this particular sector as well. We have Rohan Verma, the whole-time director and CEO of MapMy India, joining us now to discuss the earnings fine print and the outlook going forward as well. Rohan, good afternoon. Thanks a lot for joining us. Well, Q1 numbers were really strong for you. In fact, your margins expanded, and this despite the fact that your contribution margins came down a bit. What led to this margin expansion for you, and is this sustainable?
Thanks a lot for having me on your show. As we've always said, look, we're a digital, deep tech, digital products and platforms company with a unique company with this advanced maps and SaaS and APIs and IoT that we build. Hence, our contribution margins are high. They're in that 80-85% range. That's the operating leverage that we have as a company. It's asset light, debt free. So as revenues grow, which you saw strong revenue growth in this quarter, of course, our margins will also expand, and that's what's resulted, I think, in Ebitda of 46% on this revenue from operations of 65 crores and a PAT of 34%.
Rohan,
margin of 34%.
Rohan, afternoon. This is Reema here. I've got a two-part question. One, Ebitda margins at 46% is higher than the historical margins, which have been in the range of about 40-45%. You're guiding for 35 to 45% of a margin band. But do you think you will be able to sustain margins above 45% just in the near term, say in the next 2 to 3 quarters for FY23? And secondly, can you tell us why the contribution margins fell on a year-on-year basis?
Sure. So on both questions, one is EBITDA margin was 46%. Yeah, we do want it to be in the range of 35 to 45 because we also want to keep investing for long-term future growth of the company. And you've seen us do a lot of things on drones in the last 9 months, our drone-based solutions, and also our metaverse maps that you've started to see come out. So there will be long-term initiatives that we will take precedence for us so that we can focus on that for the long-term future. Now, contribution margin, what you're talking about is, I think, from FY21, contribution margin of 85% to 83% in FY22. Both are pretty high numbers. The slight difference in the year FY21 versus FY22 was this big lockdown that happened during the COVID time, leading to a gap or a fall in our IoT hardware-driven revenue. So what is IoT? It's devices that we sell to fleets and vehicles, and that triggers SaaS revenue in the years to come as they start using our software in a subscription mode. So that was a lower percentage in FY22 than FY21 than FY22, leading to this small kind of fall in contribution margin. But still, I would say 83% or anything above 80% is quite good.
Okay, so let's talk about business in detail. GTrophy, it had generated 8 crore rupees of revenues in Q1 of FY23, but it was EBITDA was zero this time around. It was nil. So by when will it turn EBITDA positive, and what kind of margins can this business make? Will it lead to some dilution for your overall margins?
Sure. So GTrophy again is an IoT and logistics SaaS company. It's device-led, but then generates SaaS revenue in times to come. We have been integrating our own IoT business that we've been running for the last 10 plus years, which was also focused on the mobility, passenger transport, taxi companies, ride-sharing companies, etc., using our devices and SaaS, so that we are creating one focused IoT, logistics, and mobility SaaS business. This integration is still underway. It will take a couple of quarters to stabilize. We're hoping by end of next quarter, this will stabilize. And so the good thing is you're seeing revenues accelerate in our IoT business. Again, there's operating leverage in this business too. It's a SaaS-driven business. So it will start contributing to EBITDA before the end of FY23. And overall margins will grow. Contribution margins may get impacted because it's like I said, a device-led business. In part, it's also, there's a lot of the business that comes purely from SaaS, nothing to do with the devices.
Rohan, what is the
contribution
current
margins might get impacted, but a little bit, but EBITDA impact overall will grow.
Rohan, if you can give us a one-word number of how much contribution comes in from IoT currently and how much can it scale up to?
It's for last year. If I think it was about IoT was about 10% of our business last year.
And how much can this number increase to?
So we don't give specific forward guidance, but
just a ballpark.
What you're seeing in quarter one was basically GTrophy did what they did in the entire year last year. They did in one quarter, so that might give you a sense of kind of where the trajectory is headed for this year.
But GTrophy is now a quarterly revenue run rate of 8 crores. How much can that increase to? Can it get to 15 crores, 20 crores, say by the end of this year? Just give us a indication of how fast.
Definitely it will cross those numbers. That's what I was trying to say, that it's accelerated by 4x from last year. So it will definitely cross 15, 20 crores.
By end of this year.
Quarterly.
Oh, okay. I'll refrain from giving specific forward guidance for now. I think let the integration happen. Let us have a few quarters of performance reporting, and I think those numbers will start becoming clearer.
Okay. So, Rohan, earlier in your conference call, and generally the idea was that there is a regulatory positive guidance for you. Government of India had restricted foreign entities from doing vehicle-based ground surveys, and the foreign entities could not take 360-degree kind of street view, which was positive for a company like yourself. But back in July, Google launched the feature where they enabled users to get a 360-degree view of any destination, restaurant or street. Do you think that will come as a dampener, or it will increase more competition in a space where you could have been the only leader?
See, from MapIndia's point of view, regulatory is just something that came in the last 1.5 years. If you see MapIndia, we've competed openly with the foreign giants since 2007, including companies like Google, in a scenario where they have had monopolistic control on Android as an operating system. This has not stopped the company, from innovating at our own end, that's in our control, but also in terms of growing our revenues and profits. So the business is strong on its own. In terms of regulatory, I think people have to look at or understand really what they have done and whether it is in compliance or not with the guidelines of the government of India. I think that's a separate matter for the government to figure out. But from MapIndia's point of view, what we also talked about is really look at MapIndia's Real View, which covers many, many more cities, hundreds of cities in fact, and the 3D metaverse maps, which cover tens of thousands of landmarks in iconic 3D, iconic locations in full 3D. And I think really what is exciting is now that you're seeing a foreign player come out with some solution and you benchmark that against MapMyIndia, people will be able to see that we're actually a world-class, cutting-edge company with more advanced technology. So while we welcome competition, it's good for people to be able to see that we are still better. So when it comes to monetization in different ways, I think we'll still have the edge.
Any investment number that you have in mind? You said you're making investments in drones, metaverse maps, etc.
See, if you see MapIndia, it's a cash-rich company, cash-generating company. We are sitting on about 392 crores of cash as of end of June, end of Q1 FY23. So there's enough kind of cash generation and profitability in the company to fund these initiatives for our product development for the future. So it's not that there's a separate capex that we have to budget for from our typical budget, and that's why we've been giving guidance around Ebitda margins and PAT, keeping in mind that revenue is also growing. But it will not have there's not a separate large capex. We are quite cost efficient, and we're a highly technology driven company, which means there's a lot of automation, AI, and machine learning. These are some of the things that differentiate us from some of the other companies which are more manual and outsourcing and services driven.
Okay. All right, Rohan, thanks a lot for joining us and taking us through your business outlook and what's happening in the industry as a whole as well. That's the word coming in from MapMyIndia. But with that, we'll slip into a short break now. Up next, we'll have Hemeen Kapadia of KR Choksey. Tune into Midcap Radar on CNBC-TV18. Markets have fallen from the top after starting really strong, so it's a good time to get a technical check on the markets. Hemeen Kapadia of KR Choksey Securities is joining us now. Hemeen, good afternoon. Thanks a lot for joining us. Well, last day of the trading week, first day of the new series as well. What are the charts suggesting?
A very good afternoon to you, Sonal. Thank you for having me. Well, frankly speaking, the markets are tired, Sonal. We've had a 2,800 point rise. We need to take a breather, which we have. We went down 650 points in 3 days. We went up 350 points in 3 days again. And now we're sort of moving sideways. The VIX is around 18.5. If we go closer to 20, I think we are going to go down a little bit, at least more from here. Overseas markets, so on a couple of points, I'll just briefly, you have crude oversold, bouncing back, some more upside. You have the CBOE VIX oversold, bouncing back, and the dollar index is precariously placed around 109. If it sustains above 109, we are going to 112. So everything seems to suggest that this correction that we walked into might take a little bit longer. And levels on the downside are 17,200 and 16,800. In the near term, about 17,750 on the upside might open an unlikely upside to 17,900. So we walked into a breather. I believe this is going to be there at least for a few trading sessions. And yes, I don't think it's a reversal, but a negative overhang, downward bias seems to have creeped in. Yeah.
Okay, downward bias in the markets. What about stocks, Hemeen?
Multiple stocks. Firstly, I have a buy call on Crompton Greaves Consumer. We've given an upward breakout from an ascending triangle pattern. Today we are seeing a small unraveling, but the breakout remains intact, sacrosanct. So we have a buy on Crompton Greaves Consumer at 410, stop loss 398, target 434. Secondly, a sell call on IndusInd Bank. Overbought, negative divergence, crossover sells by the mechanical indicators. So a correction seems to be creeping in. So sell at on IndusInd Bank at 1070, stop loss 1085, and target 1040. Lastly, a sell call on Aurobindo Pharma. Lower top, lower bottoms, continuing indicator, sell below 55-day exponential moving average. Everything seems to suggest that we are in a short-term downtrend, and this looks like extending further. So sell at 552, stop loss 562, and a target of 532.
Okay, all right, Hemeen, thanks a lot for joining us and have a great weekend ahead. That's all about the technicals of the market. It's time to drill it down to individual stocks. Ekta is standing by with all the mid-cap movers in trade today. Hey, Ekta.
Thanks for that. Well, yes, it's definitely a lively market when it comes to a lot of the broader market stocks. So I'll start with a lot of the stocks which are at 52-week highs. So for example, Astra Micro, Banco Products, Cantabile Retail, Lumax Industries, to name a few. So all of these stocks, Lumax, however, is off the day's high. Week-to-date gainers, so I'm going to talk about that since it's Friday. Surya Roshni, Anand Raj, all of these stocks have gained over 15% on a week-to-date basis. TexRail, Time Technoplast, for example, also has been hovering at 52-week highs. And lastly, on a week-to-date losing basis, we have stocks such as Kalyan Jewelers, which has lost around 3% today, Gayatri Projects, Ramki Infra, both from the entire infrastructure space, and even something like a Hind Motors, which has had a bit of a tough week.
Thank you very much for that. On that note, we'll slip into a very short break. We'll come back and get you more on individual stocks. Our Midcap Spotlight segment is also. Welcome back. This is our favorite Midcap Spotlight segment. And today we're going to be talking about the new listing Syrma SGS Tech. Well, it had a good debut. The stock listed at a 19% premium to the offer price. And we've been talking about the company, its valuations, its size. But right now, my colleague Vahishta is joining in, and she's going to be telling us how this new company on the block compares with others like Amber as well as Dixon Technology in terms of their business models, revenue size, as well as valuations. Vahishta, it's over to you.
Thanks for that, Rima. Well, you're right in saying that Syrma SGS Technologies has had a good opening today. It was listed at a price of 260 rupees versus the offer price of 220 rupees per share. The company is engaged in electronics manufacturing services. Now, let's do a peer comparison of some players in the EMS industry. For Syrma, it is predominantly into industrials, into home appliances, into the automotive segment, while Amber Enterprises is predominantly into consumer electronics, and Dixon Technologies is into consumer electronics, into mobiles, into home appliances, and many other segments. Moving on to how the financials look for these companies, for FY22, the revenues for Syrma SGS Technologies is much lower than its peers at approximately 1,200 crores, while for Dixon Technologies is higher at 10,700 crores, and Amber is at approximately 4,200 crores. On the margin front, though, Syrma SGS Technologies enjoys better Ebitda margins compared with its peers at 10%, while Dixon is at 3.5% and Amber is in the mid-range of approximately 6.5%. On the export sales front as well, Syrma SGS Technologies has nearly 37% of the revenues coming in from exports, while for the remaining two, Amber and Dixon, less than 1% that comes in. Looking on the valuations front, Dixon Technologies is at approximately 111 times the P multiple, while Amber is at 76 times, and Syrma is trading at a much lower P multiple than its peers at approximately 58 times. So all in all, to conclude, the IPO has witnessed a good traction from the investors community as a whole and has been subscribed 33 times. Back to you.
Thank you very much, Vahishta, for explaining that in great detail. Let's move on and talk about Lumax Autotech. Now, the stock has gained 80% in this year. Sonia is here to tell us what's driving the stock up and away. Sonia.
Well, thanks a lot for that. Lumax Autotech is just another auto ancillary which is surging because of more demand that's coming in from OEMs on account of the new launches as well as the upgrades. As you rightly pointed out, the stock has gained 80% this year and has hit a fresh 52-week high. So what does the company do? Lumax Autotech manufactures gear shifters, emission systems, and the chassis, which is the outer body for two-wheelers and three-wheelers. In fact, almost 40% of its revenues comes from the two- and three-wheeler segment, while 24% of its revenues comes from the passenger car segment. It has a very rich clientele. Almost all the OEMs, including Maruti, Tata Motors, M&M, Toyota, Skoda, Volkswagen, Bajaj Auto are clients of Lumax, and very strong earnings trajectory as well. In the quarter gone by, the revenue growth was 62%, the EBITDA was up 160%, and the company has a healthy order book to the tune of 600 crores, out of which 75% are for new products. So it's not only from the replacement market, but there's a large chunk, a majority of it comes from new products as well. The company is also in discussions with electric vehicle two-wheeler manufacturers for orders. They haven't got any EV orders just yet, but they are in late-stage discussions over there, and they've also have an enabling resolution to raise 400 crores if they want to put fresh capex on board. So all in all, a good company, strong potential because of surging demand from the auto OEMs. Back to you.
Thank you very much, Sonia, for that. With that, we're out of time on Midcap Radar. From the entire team, thank you for watching. Your stocks when we return.